All right, good morning, everyone. It is 7:52 on the morning of February 15th, 2023, and this is my pre-market strategy session. So, what do we have going on today? Well, the title of the video is I'm Still Bullish. And I think it's going to be a pretty quiet day. Pre-market here, let's just kind of take a look. And really, the strategy that I'm using is my relative strength strategy. If you've watched the video, watched my videos, you know what it is. If not, I'll cover it one more time here. You see these relative strength indices underneath of my 1 minute and 10 minute on the Qs. I look for those. If I want to get into a long position, I look for those to go into oversold and start coming out of oversold at the same time that the VIX is coming out of overbought, has gone into overbought and is coming out of overbought. And that's what I use to trade. They don't always line up, and so sometimes I'll get 3-4 trades a week, and sometimes I get 0 trades a week, but sometimes it's only 1 or 2 trades a week. So I'm in a position now. I'm straddling the Qs at 303. I put on right here on Monday the 13th. Wow, seems like, but that's not right. Yeah. Monday the 13th, before yesterday's CPI release. That's right. And so I put on a straddle right here around 303. My expirations are 2 months out there for the April expiration, monthly expiration. And I'm expecting, by the time, I imagine by the time another 4 weeks rolls by, we're going to be significantly one direction or the other in order for my my spread or my straddle to be profitable, whichever way it goes. So I am bullish. My bias is bullish, but I don't care which way it goes. As long as it goes, which it's going to do. And I've kind of been looking around at what could move the market on what days and stuff. And so we do have on the 23rd of February, we have a second estimate, they call it, but it's actually it's a revision of fourth quarter GDP. And the Fed is claiming to be data driven. And so then on March 30th, a month later, we get a third estimate of the fourth quarter 2022 number. So that could move things a little bit. And then we get gross domestic product, state and personal income by state. Okay, well, yeah, March 31st. First quarter advanced estimate, April 27th. Then second estimate, May 25th, so on and so on and so on. It's generally speaking, it's going to be pretty quiet. PMI comes out and I like the Chicago PMI best. It comes out on the first working day of each month, followed by services on the third working day, and those are released at 9:45 in the morning. So for the next couple of weeks, as far as data goes, and the Fed being data driven, there really isn't much of a catalyst for an up or down movement, really. And there's the weekly jobs, but it's weekly unemployment and so forth. But generally speaking, there's nothing really in the short-term forecast that's going to make the market move to extremes. With that said, eventually my bullish bias, will turn bearish. One thing for sure is that when we're hanging around 19 on the VIX, now I also know that the VIX isn't the volatility index that really suits the Qs very well. The NASDAQ, but it does work a lot better than the VXN, because the VXN is just so hard from here. Look at this. This is just extremely difficult. I can't make sense of that right there. So I still just use the VIX. The VIX is so much cleaner and easier, in my opinion, to use. And this 1912 line right here really is the line that I'm looking for things to break down below. I'd love to see it go into 16. Now, with that said, historically speaking, let's go back into the monthly here. And you can see while the yield curve is inverted, here's the monthly yield curve. This is the yield curve, and it's inverted, and it's gone into new record territory here. Let's see. Let's put that down. The new record territory is negative 9.69. So you can almost get, at one point this morning, you can get 1,000 points. Well, the bond market isn't open until 8:30, so that's not very, you can't really trust that so much. So let me wait until the bond market opens. I'll just put it right there for right now. But getting back to my point is that during the inversion, the equity markets can remain bullish. Here's the 2008 market before the housing bubble burst. And here's the 2000 market before the dot-com bubble burst. And throughout these periods right in here, let me get rid of the circles. I'll recircle it. In these areas right in here, the markets remain bullish all the way up until about a month or two before the normalizing of the yield curve. And so, and in those times, in the time of the yield curve inversion, the VIX remained elevated roughly around 19 or so, right? So do I expect things to be different, this time? No, not really. Just in the short term, I'm looking for it to dive down to like 16 for, to really pull in some bullish behavior on the market. And really what that's going to set up is what's going on with gold right now. What I believe is happening right now with retail money, or it's January, February, and March tend to be bullish months of the year, and what I think is setting up is something like what we're seeing on gold. So gold had this big distribution pattern right here over the span of, I think it's like 2 years. So here's August 2020, and here's March 2022. So what is that? 18 months? Yeah, 18 months, is that right? 6 August. Okay, so almost 18 months. It's 17 months. So almost 18 months. This is a big distribution pattern. Gold has reached, its top for what could be probably 5 to 10 years now. And this is a big old sucker's rally. I hate to call it a sucker's rally because there are probably plenty of people who have made plenty of money on this move up. But if there are people who started getting bullish, and started getting FOMO and excited and stuff right in here, up in here, then, they're stuck unless, they got to cut losses if they started getting into gold right here. And so, in my opinion, we're about to see something similar happen on the Qs. It's going to start, getting high, and it's going to get into, close to the new highs or whatever. And it's going to suck in a whole bunch of irrational exuberance, whatever you want to call it. I don't know where it's going to be. I don't know where the price is going to be, but it's going to suck in a lot of retail money, and then it's just going to start rolling over the same way that gold is rolling over right now. So, but in the short term, I'm willing to trade the Qs to the bullish side to take advantage of what I believe we're about to see is going to be very similar to the way gold is set up. So short term, I'm bullish. It's just a matter of time, though, until this yield curve starts to normalize again and we see the next leg down. And historically speaking, these yield curve inversions that then normalize have led to market crashes. Now, will we get a market crash this next time? Because everybody and their mother is watching this chart like this, And when you get so many eyes on the same sort of phenomenon, sometimes it just doesn't work out you know, I like to, you know, the bite rule, the apple. You know, New York City is called the Big Apple because there's basically enough prosperity to go around for everyone to get a bite, right? So if you move to a town, you know, and it's a town with lots of opportunity and so on and so on, then you get a bite at the apple, you get your opportunity, you know, and sometimes you even get a second bite. Like right here, this is the first bite, predicting a big crash, and sure enough, the dot-com bubble crashed, and, you know, a whole lot of speculative money on anything that was IPO'd that had a dot-com behind it. You know, there were a lot of people who made a lot of money on the ramp up of that dot-com bubble. Same thing with the housing bubble. There are a lot of people who made a lot of money with all those, you know, liars' mortgages. You know, all the people who were saying, "Yeah, I make $100,000 a year, and I can." You didn't have to verify income, you know. And so there were a lot of people who were buying and selling houses in this period of time who made a lot of money. But then there were people who bought houses and they got stuck and they were underwater. And I'm sure you've heard it. And there were plenty of foreclosures, and there were all sorts of crazy governmental programs to keep people from being, you know, homeless and so on and so on. It was, you know, pretty crazy. Well, this time around, I'm sure that when this thing starts to normalize again, that there is going to be a downturn on the equity markets. I'm absolutely positive of that. But will it be a crash? Will it be, you know, we've had in recent history, in the past 20 plus years, we've had a bit of practice with mitigating these crazy crashes. And actually, the COVID was a bit of a example of that. You know, the ramp down, the crash down that happened in 2020 right here, I mean, this is the fastest market crash and recovery in history, right? So there was this crash, lasted for, I think it was about 3 months. Let's see, February, end of February to, it was only a month, to February, the beginning, let's see, we'll call it mid to late February down to mid to late March. Wow, that was only a month. And then 6 months later, we're back at new highs on the Qs. So, you know, stimulus, the Fed dropped rates, and stimulus was passed by the Congress and signed in by the president. So the Fed now is saying, we're keeping rates high, you know, no matter what happens, going forward, we're going to put rates up and keep them there. So will we get another crash? I mean, you know, I have no doubt that we will see another downturn. No doubt in my mind, we will see another downturn in the equity markets when this starts to normalize again. When this 10-year, 2-year spread starts to normalize again. But will it be the crash that we saw here in 2020? In 2020, we were setting up for a pretty nasty recession. Let me kind of go back here a little bit. Let's go back here to 2008. Will we get the crash that we saw, here in 2008? Will we get the crash that we saw 2001? Wow, that's a huge one. Nasdaq, yeah, that was tech. Oof, look at that, man. That goes negative according to the data here. That goes into negative territory. That's like a negative. Let me go from the top here all the way to the bottom. Yeah, that's negative 98. Yeah, it's crazy. So anyway, I do believe we're going to get a severe downturn, but we may not get the crash this time around. We may not get the huge crash down. Tech is well entrenched. There's a boatload of money in really solid tech companies. I mean, Google, Microsoft, not so much. I don't really like the social media like Twitter and Facebook, but Tesla is considered a tech company. There's been immense, seismic, enormous shifts in technology since even 2001 and since 2008. I believe tech is the future. So, we will get a downturn. It may kind of look like a crash, but my guess is that it's actually going to be kind of short-lived. Yeah, I'm bullish in the short term for what I'm going to go ahead and call is a sucker's rally. But then once the 10-year, 2-year starts to invert, I believe we will see bearish conditions again. But I don't think we're going to see the crash again. I don't think we're going to see another crash like what we saw in 2001, 2008. Okay. So here's gold. Let's take a look at oil here real quick. There are geopolitical occurrences and, policy, U.S. policy. Pardon the laser light show here. Let me get rid of these actually. And there are policies that are being passed that are really keeping energy, in particular oil, elevated here. I think it's absolutely completely unnecessary. We don't need. I don't know why this. It just doesn't make sense to me that we are this elevated on oil. I mean, and the reason it doesn't make sense to me is there's no reason for all this geopolitical tension. There's so many ways forward in a collaborative sense between nations and borders and blah 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 that really it just is absolutely unnecessary. But geopolitical tensions are really what's supporting oil at this price up here. And as long as oil stays elevated like this or moves up, then we will see more pressure on inflation. So it is going to be something to keep an eye on. If we get another round of inflation, it's probably going to be because energy prices go higher. And if that happens with energy prices, then things will get a lot. The bearishness will get. That's another sort of place where the bearishness. That's another sort of source of what could cause the market to downturn. Is not so much the normalization of the yield curve as it is inflation. And energy is, the energy prices are a significant contributor to the inflation. So, this, I'm keeping an eye on oil. As of right now, the downward trajectory and even sort of the stabilizing of oil prices here is bullish. Just quite simply, the dollar did pop up here a little bit and was kind of hanging around high just a tad bit. I think this is a short-term rally here. We might see another leg higher because it is putting in a bear flag right here. We might see this consolidation break out for a little bit more movement on the dollar. But I don't think we're going back to highs. The dollar is the safety play. And so when things start turning down, when things are looking really bearish, people buy dollars because it's safe. And same thing with 10-year treasuries. And the bond market always gets it right. So the 10-year treasury, there's so much demand for the 10-year treasury that the price of the treasury goes up, which drives the yield down. And that's what we're seeing right now. So there is something on the horizon, whatever it is exactly, whether it's energy, war, God forbid, more war in other places. People are seeking safety in the 10 years where a vast majority of people go, investors, so on and so forth, go. They go to the 10-year treasury for safety. Bitcoin's doing something kind of interesting here. Personally, I think it's short term. I think it's just a matter of time until Bitcoin starts coming back down again. Yeah, so I'm bullish. I'm cautiously, actually, I'm just going to pay attention to what my charts say, and I'm going to trade accordingly. In the meantime, though, I do have that straddle over 303 working, and I'll see in a month worth of time. I'll see how far in or out of the money I am on those things. All right, yeah, that's kind of my strategy session for the morning. I am looking for a break above 313.25 here, and then a higher move up. What I think it's going to look like is something like we'll muddle around for a couple weeks and then we'll break out and then do something like that. So, all right, everybody. Good luck out there. Keep your wrists tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. Thanks for tuning in. I am out.